All right. Well, good afternoon, everyone, and welcome to NHNRE's webinar on redefining risk finance. I'm Caitlin Snyder, and I have the pleasure of serving as NHNRE's Managing Director, and I'll be your MC for today's webinar. To answer a few questions right away, yes, this webinar is being recorded, and yes, a copy will be made available to everyone who registered for today's webinar. We're going to take questions at the end and ask that you submit them through Zoom's Q&A box. I wanted to start with a big thank you to Alliant and to RDO for their sponsorship of today's webinar and their support of NHNRA and our members. We know that insurance has been a particularly challenging pain point over the past couple of years, and we're proud of the partnership and the work our sponsors have done to step outside the conventional boxes of insurance world and think about risk financing in a different way, one that allows you to reduce costs and lock in fixed costs over time. Here to guide the discussion over the next hour is John Gizzo, who is a SVP at Alliance Insurance Services, bringing more than 25 years of experience in the insurance and risk management industry. Jordan Moss is the founder of Catalyst Housing Group, a multifamily company focused on the expansion of workforce housing in California. TC Ostrander co-founded RDO. Prior to that, he spent his career in private equity and venture capital, most recently leading the Catalyst Innovation Lab, a venture capital platform focused on real estate technology companies. And last but not least, we've got Roberto Rivera, who also co-founded RDO, and he focuses on risk finance and the firm strategy. So with that, I will pause and hand it over to you, John.
Great. Thank you so much. First, thank you, Samantha and Caitlin, for all the work you did to get the webinar in place today. So what I want to mention today, we're going to discuss an approach to optimize your cost of capital to fund future losses most effectively. This isn't about buying insurance or raising deductibles or captives, but it's about using risk-adjusted return on capital, or RAROC, to build a more efficient financial structure to fund future losses. The savings can be significant, and what's really unique is it can fix costs for a 3 to 5 year period, which in the affordable housing space can be an incredible thing to lock in costs around the risk and insurance side. I do want to reiterate, this is a discussion about finance and not so much about insurance, and keep these kind of three words in mind. It's about certainty, stability, and control. And last comment I do want to make, although I would hope moving forward on any of these strategies, you would engage Alliant on the insurance brokerage side. RDA will work with your broker and works with all brokers. So I want to make sure this is clear that it's not an exclusive to Alliant. With that, Roberto.
Thanks, John. And I'll share my screen. There you go. And there we are. Perfect. So, hello, everybody. I'll start off the conversation by giving just a minute of myself. In my previous life, I was a structured reinsurance broker. I used to represent insurance companies and how they fund for their own risks. And what I learned in my career was that it is very similar in the way that retail customers or the end buyer of insurance does their transaction. So we're taking a reinsurance approach to the retail market, right? When we start looking at that, we try to unpack what the transaction looks like. When we buy an insurance policy, what does it do for us? What does it provide, right? Because if I'm going to replace that insurance policy with other structures, other things, I need to recreate that product, right? So we open that up and we say that an insurance policy has three primary purposes. Right? The first one, it's a credit enhancement tool. What does that mean? Well, it means that when you buy an insurance policy, an insurance company, which has a publicly uh, recognized credit rating, is telling the world, I'm going to pay these types of claims on your behalf. And that matters. Matters for a couple of reasons. One, you have contractual requirements, lending requirements, your contracting partners all require you to have insurance because they want to lower the risk associated with those operational claims on their transactions. So whenever we look at alternative risk transfer, which is what we call our product, we always look at how are we going to front for our transaction. So we're going to rent that paper. That's a credit enhancement tool. And that's step number one, understanding what we have to provide all our partners. And we do that for our structures. The second purpose of insurance that we fulfill is financing for future losses. And that's kind of the heart of what we do, right? That's the primary element of where we're trying to accomplish. When you pay premiums, right? You pay premiums to an insurance company. In return, that insurance company is going to pay future claims on your behalf. And that's an asset and a liability on their balance sheet, right? You're paying premiums, you have claims, they pay those claims on your behalf, and they manage that premium growth over time. So what we do is we analyze what those future claims are and how bad those claims can be, and we create a financing process, if you will, over that 3 to 5 year term. What that gives us is stability and, more importantly, efficiency, right? Why do I say efficiency? Well, it is more efficient to use your capital, or it might be more efficient to use alternative sources of capital to finance your future losses. And the question would be, well, maybe why? Why is it more effective? Well, because our cost structures might be more efficient, right? We have less costs associated with replacing a dollar from a professional risk taker when we do it for ourselves, right? We have different sources of income. We might have investors, or we might have alternative capital sources that allow us to finance those future losses more effectively. In addition to that, when we start financing for losses over multiple years, we also start accelerating or getting access to investment income and underwriting profit. And that in itself becomes an interesting proposition, especially in the affordable housing space where costs per door are pretty steep, right? $1,000, $1,500, $2,000, depending on what geography you might be in. That's actually a lot of money that goes into a financing structure. So therefore, managing that, or a percentage of that on our behalf, is an interesting proposition. The last thing that insurance provides, right, is that volatility management. And that's kind of technical speak to saying I'm always going to buy insurance for the extreme or the catastrophic event, just like an insurance company does, right? We finance or we fund for the expected losses, and we buy reinsurance or insurance for the unexpected loss, for the catastrophic event. So when you start thinking about alternative transfer, you start thinking about these three elements over time, right? I need to have a front. I'm going to finance some of my own losses, not unlike taking a deductible, though a little more coordinated with multiple lines and multiple years. And then I'm going to buy extreme insurance, right, for the catastrophic event. So an excess tower or reinsurance over multiple lines and multiple years. And that's the crux of what we do. We create a big funding mechanism or an analysis that develops an alternative risk transfer structure where we either validate the retail marketplace. Hey, we can't do this more effectively. We're getting a really good deal from the retail marketplace and we should be buying retail insurance. Or in the alternative, a viable financial path forward. How does this work, right? So I'm showing here just the traditional value chain of the retail insurance market, right? On the left-hand side is the client, kind of to call it the retail customer. And we call that as a price taker, right? Because it has very few levers to pull on a single year basis, right? Usually that client accesses the market through a retail broker who oftentimes goes to a wholesale broker who goes to a retail insurer who then goes to a reinsurance broker, not unlike what I used to do, who then goes to a reinsurance company who then manages cash through an investment banker, fund manager, and ultimately risk capital. Why is the point of showing this value chain? Well, it's because each one of those entities between the company and the risk capital is a source of costs, right? That is not adding to the funding mechanism that we talked about previously. So if we can replace some of that risk capital closer to the client, we should be more efficient. I'm sure you wouldn't be surprised if I told you that for every dollar of premium that you put into the retail marketplace, there's anywhere between 20 and 40% distribution costs, right? Between all those layers. So can we do this more effectively? And the answer is yes, right? That's a more effective transaction, right? The client now structures its own capital, right? It creates its funding mechanism, it creates its own product, obviously in agreement with its broker or risk consultant, right? We kind of develop a multi-year, multi-line strategy for that. And then we go direct to the reinsurer, right? Or direct to capital to fulfill those requirements, right? And that's a very different transaction. A common question I usually get at this point is like, why isn't everybody doing this? Well, I think the answer is because not everybody speaks reinsurance, if you will. To be able to transact effectively in the reinsurance marketplace, it requires a higher level of data and analysis. And that's what we do, right? We put the inputs of a client that an input the clients have into, let's call it the needs of the reinsurers. And that allows us to transact effectively in that market. So the transaction is more effective. Now I'll turn it over to TC and Jordan to talk a little bit about what we want to achieve with it, right? Kind of going back to John's points earlier, transparency, stability, and control. And we'll talk a little bit about it from, let's call it the client's perspective. TC, Jordan,
Yep.
over to you.
Thanks, Roberto. Obviously, a key focus here is on cost reduction and deriving more economic value from how you address insurance or risk transfer. But beyond that, there are definite operational implications that come along with the traditional insurance industry, and there are operational advantages from moving into an alternative risk transfer structure. To keep with the same themes, transparency, stability, and control, these are what we want to convey to our clients and what our clients can achieve when they move into one of these art structures. Next slide, Roberto. More specifically, insurance is a black box, right? Traditional insurance is a black box. When you go to acquire a new property, right, and you're subject to the dynamics of whatever market you're acquiring that property in, oftentimes, you're getting that binding quote at the end of a lengthy acquisitions process where you're under LOI, earnest money's gone hard, and you're at the mercy of the insurance market. Jordan, I don't know if you want to expand a little bit about that, given your experience.
No, I think that's exactly right. It's a pretty unnerving experience today to be taking a look at maybe historical financials, trying to get a feel for whether they're going to match what your costs are going to be going forward, but not necessarily knowing whether, your profile matches that of the seller. And also, I mean, you're talking about acquisitions, but just renewals. I'm sure you'll get to that as well. But yet another unnerving process, for anybody on the phone here who, manages a portfolio and is trying to get some feel year to year for what their costs are going to be. I mean, one thing that has dawned on me is when I started in this business a couple decades ago, insurance was such a relatively meaningless part of your overall expense structure. I don't think many people paid too much attention to it. It was a couple $100 a unit a year. And just looking at, what has happened recently and how significant that cost is today, I would double click on what Roberto said about most people just not really speaking reinsurance or understanding, how this souffle is baked. And having been close to you guys, as you sort of ideated on what is now RDO and launching this, it's been an eye-opening experience to me. I know that it can be painful on your end because there's a lot of educating that needs to be done, but obviously the traditional model is broken, and so really excited about where you guys are headed here.
Yeah, thanks, Jordan. I mean, I think similarly on claims, we talk to, very sophisticated commercial real estate owners all the time who obviously have to buy insurance. They're all borrowing money to finance their business. but they will strenuously try to never file a claim. And the reason why they do that is obviously they're, very worried about what's going to happen to their premium in the next year, right? And you have no visibility into that. You have very little visibility into how the market is actually underwriting you. And so you end up in a situation where you're buying this increasingly expensive product and then you're strenuously trying not to use it. And, the difference in the alternative risk transfer scenario is you're essentially both filing claims and you're managing the risk capital, right? And since you control and have transparency into how the program works and how it's financed and the current state of the program, you can know with a great degree of certainty how filing that claim is going to impact the financial condition of the program. Similarly, on stability, I think there's a lot of, operational issues that are caused by the existing traditional insurance market. I think financial planning is a key one, right? Like every commercial real estate firm spends a lot of time and has a lot of sophistication coming up with property and portfolio-wide budgets for the next year or whatever given time period, looking at variance and performance and trying to decide where they're going to allocate scarce capital to drive better performance in the next 12 months. And oftentimes they'll leave the insurance line item blank. Um, and, obviously, when you've had an expectation of insurance costs being somewhere and upon renewal, they go way up, that causes the work that you've done to deteriorate. So I don't know, Jordan, if you've had any, experience with this firsthand.
Yeah, we definitely have. I mean, I'm sure that anybody who has been in traditional markets and has just been waiting around to see what their renewal is going to be, again, has experienced the same thing, and what that instability feels like as it relates to the financial planning that you're talking about. I was looking at that slide Roberto went through with, I think there were 7 boxes in between, being a price taker and a price setter. And I was wondering, if I have a bunch of little kids, so I see their homework all the time, and I'm used to, like, them having pop quizzes at school. But I was wondering if you guys gave this as a pop quiz to people and asked them to fill out, those 7 boxes in between, how many people would even understand what's really going on and the different layers that exist. And, arguably each one of them, I know you said, creates in total 20 to 40% load, but it also just creates a bunch of instability as well, I think, just not knowing where anybody's going to land when you get to your ultimate number at the end of the day.
And then lastly, on this category, it's capital structuring. Real estate people are very sophisticated capital structures. Real estate capital stacks have many flavors of equity, many flavors of debt. Real estate people are always talking to the financial markets, and yet when it comes to insurance, we've become accustomed to essentially being retraded every year on every exposure, which is how traditional insurance works. And in addition to that, we've given up the advantage of, to Roberto's earlier point, marrying uncorrelated risks with other risks, and then therefore reducing the overall amount of funding required to pay for those risks. The other thing about real estate people being capital markets people is this can be when you move insurance from what is a problematic cost center into something that is now an asset for you, right? You can align that asset with the rest of your capital structuring. And sometimes you'll run the numbers and you'll say, I'm in the capital markets today, but the returns I can get on managing my risk transfer more myself are actually more attractive than I can get for managing my core business. Lastly, on control, uh, this one's near and dear to my heart. Personally, this was the start of my journey into RDO. But, I think obviously the premium growth that's happened over the last 5 to 10 years is a problem. What I would argue is as big of a problem is the structure or the terms and conditions of policies changing dramatically, such that we are all more self-insured than we were 10 years ago, right? Deductibles have gone way up, exclusions are proliferating, and oftentimes limits will be lower than the value of the asset. So we're all more exposed financially to risk. Um, And even with that, uh, it's difficult to marry your risk management from an operational perspective with how you think about transferring risk, either buying traditional insurance or moving into an art program. What's done in these programs is really a ground up analysis of risk, whether it's a penny of risk or $1 million of risk. We come up with a loss stratification forecast for a portfolio and tell you exactly where we think you're going to incur expenses due to risk, whether they're general liability or whether they're property related. And what that allows you to do, what that unlocks, is basically understand what's going to drive the outcome of your program and then marry your operational risk management perfectly with the structure of your risk transfer, right? And especially when you maintain access to your own underwriting income at the end of the day, and therefore are very incentivized to provide really good operational risk management. The incentives are much greater than a traditional insurance policy, where you're in a situation where the best that they can do is maybe give you a slight premium break for 1 year for taking some action at the property level. Um, Finally is underwriting, and this is a common complaint that we hear is, why am I being underwritten, or why am I receiving the same pricing as, somebody else who looks like me but is not as good of an operator? If you look at my loss experience, um, I have not incurred significant losses on property or GL, or I have taken action to promote better risk management within the portfolio. Why am I not seeing that in terms of my insurance pricing? And the reality is most of your pricing is driven by the market, or it's driven by factors that are not specific to you in a traditional insurance transaction. Whereas in an art transaction, that underwriting is totally focused on your portfolio, right? We do incorporate market data in the analysis, but we are truly underwriting you specifically. And when you do that, you can get credit for being a better operator, which I think is something that the industry from the commercial real estate perspective would desperately like to see. I don't know, Jordan, if you have anything to add on either of those topics.
No, I don't think so. I think you nailed it.
Yeah. Back to you, Roberto.
Thanks, TC. So why do we do this, right? Well, that's been a lead up to this graphic, which is an average portfolio, about 3,500 units, geographically exposed, meaning that it has either some Florida exposure or Texas exposure or California exposure, so quakes, severe convective storms, or hurricanes, or jurisdictional exposure, right? So we have exposure to liability claims and some of the jurisdictions that are more challenging in terms of settlements. And what this looks at is both a property and liability comparison, right, over 3 years of an art structure versus a retail structure, right? And what we're saying here is that the average cost of a alternative risk transfer structure is going to be about $11 million for the 3-year term versus the estimated retail structure, which is about $16 million, right? So a pretty hefty difference, about $5 million over 3 years. Where does that difference come from? Well, first, it comes from the fact that you're replacing a lot of the capacity in the primary layers, which tends to be inefficient, right? It's a big funding mechanism. You're just transferring money to somebody else's balance sheet so they hold on your behalf, and it comes back to you in the form of claim payments. Well, now you're replacing a large portion of that yourself. Second, you now have also access to investment income and underwriting profit. So when you have good experience, right? Because most portfolios of well-managed properties have good experience. So when you have good experience, you're able to use that profit to benefit your program, give yourself basically a better rate on the subsequent years. And finally, investment income. All these are structures that are cash heavy. Those are being invested in very liquid, stable investments, 3-4% returns, and that works to your benefit. So the outcome of a well-structured program looks similar to that. if retail pricing is excellent and you're having an excellent deal, some retail markets are excellent for very specific portfolios. They get great deals. What happens is that there's a crossover of the lines and you can't do it more effectively, right? The art structured program is not more effective than the retail program, right? So you would continue buying retail insurance. But I would say in most of our analyses in this space where we know it's very challenged, we're able to secure that difference in costs, right? So we're targeting between 20 and 30% reduction in costs, a combination of underwriting profit, investment income, and distribution costs. The last slide is actually super interesting to me because it helps us understand what our return on capital is. TC and Jordan made the comments on real estate is particularly well poised, right? That's what real estate operators are really good at is capital structuring, raising capital, developing these very complicated or advanced financing techniques, and keeping a focus on what the return on that exposure is, right? But you're trying to be very efficient. Well, we take a similar approach to that from an insurance side. So all these structures, right, would have some sort of balance sheet exposure, or they might not, depending on what the actual final product is. But this is just an example, right? In this case particularly, we're saying that the balance sheet exposure for this program over 5 years is $5 million. Right? It's finite risk. We know that for a fact. We're focusing on keeping that by buying all sorts of insurance to make sure that that is our worst case scenario. And in this theoretical portfolio, we're saying that the expected outcome, right, the underwriting results, investment income plus underwriting profit is going to be $5 million. Well, what is my return on capital on that, right? And that it's about an 82% RAROC, right? And I give the definition of risk-adjusted return on capital for insurance in the bottom, right? Where RAROC is underwriting profit plus investment income minus the cost of your capital, right? Because you're going to be exposing some of that balance sheet. And that's going to have a cost that you're going to allocate. And then over that capital exposed. And that allows us to compare different structures effectively, right? We're able to compare what a type of deductible does to the structure from a RAROC perspective, or how much taking a 3-year program becomes in terms of profit and RAROC on a multi-year basis. And I think that's key because it lets us analyze different structures over different time periods to really find the right blend of risk versus reward. I don't know, John, maybe you have a comment there from your perspective?
Yes, I do. And again, if you're thinking this from a financial approach versus the traditional insurance piece, because those premium dollars that go out never come back, right? Those are gone. Even if the market's softening, there's the reinsurance marketplace usually also follows in that same space as what's happening in the retail space. So if you kind of shift thinking again from a financial perspective, what can this really mean? And the measuring tool is the RAROC, right? So then it becomes an important tool. And I would like to ask Jordan to kind of opine on this because one of the things I hear is, well, hey, this is just self-insuring and I'm just opening up my balance sheet and I can't expose the $5 million. What happens if it all goes south and then what? And Jordan, if you can give your thoughts on that, but before you do, this is what we're talking about, building the model with data and fact to determine what the RAROC is. And then and then if you're worried about this, if it's a $10 million exposure you're worried about, how do you structure for that? And then again, back to RAROC, does it make a financial sense to do that? So Jordan, would love to hear your thoughts on what you've experienced when you got into this modeling and then realized, hey, this actually is a better tool for me than going to the traditional markets or marketplace or just raising your deductible or self-insuring.
Yeah, I mean, I think there's a lot there and don't want to put anybody to sleep. I mean, I think this analysis is going to be different for everybody depending upon the size of their balance sheet. As Roberto touched on earlier, I mean, the answer to this may be utilizing your own balance sheet. It may be renting somebody else's balance sheet. I think it all sort of depends. I know people don't like those answers that, it depends. But I think back to one topic that John, you started with. I mean, I think in your opening comments, you mentioned think of this not as, insurance, but just through the mindset of, finance or structured finance. I think, and TC and Roberto have both doubled down on this. I mean, every owner of real estate, spends a lot of their time thinking about fairly complex finance structures, whether it's on, the debt or the equity side or at a portfolio level or an asset level. And I think this is an area where we all have been price takers. I think that is absolutely the right term that was used, where, again, we're sitting around and waiting to find out what our insurance is going to cost us going forward. And moving into this world where, this is a very important piece of the puzzle. And so you may be exposing, to the extent that you end up exposing your own balance sheet, you're clearly going to look at the risk associated with that and the potential, returns potentially both at the portfolio level, but also, at the asset level. And hopefully end up in a place where you feel like, you're taking no more risk than you would be taking in the traditional markets, but you have a lot of upside, and potential for, pretty significant savings. And so that's how we think about it. Again, I think everybody will, think about this differently depending upon who they are, the size of their portfolio, balance sheet, et cetera. But I don't know, TC, Roberto, if you have anything to add to that.
I mean, the only thing I would add is, I think a lot of people sort of expect that with these types of structures that you have to source capital from somewhere, third-party capital from somewhere. Most often for portfolios of really any size, and this is just because insurance has gotten so expensive. So like the price level of insurance has gone up considerably, and then the volatility is what it is. But if you redirect premiums that you're currently spending on retail insurance into the structure, oftentimes that is enough capital to support the structure. So we're not saying you're going to have to find capital from elsewhere or allocate capital that's currently in abeyance and maybe earmarked for other projects within the portfolio or for some other use. Oftentimes, most often, and I would almost say as a rule, what we're doing is we're redirecting premium spend in order to support the program. Roberto?
I'll add to that. There's two ways to look at it, right? You can take a very sophisticated approach and think of an alternative risk transfer structure as insurance operations within your business, and we can go as developed as possible, right? We can actually have an insurance company fully focused on your portfolio with all the bells and whistles associated with that. And we have, a couple questions that will help us inform a little bit of that discussion. We'll wait for those to the end. So we can take an insurance company approach to it and really develop complexity and really create an insurance company that's going to generate its own independent income stream and profit center, right? So that's one approach. The other approach is we can also make this very simple, right? We can create a box that has a max exposure, right? A worst case scenario. And, at the end of the term, 3 years or 5 years, if it's performed, you will have some return premium, right? Which is great. It's a dividend that you get at the end of the day, which you would not have access to that otherwise, right? Unless you have this kind of structure. So the point is that our customers are kind of in both camps. Some just see this as a purchase. They're buying a more effective structure that they're putting in place in 3 years. And the really effective ones don't require additional capital, but a reorientation of the premiums. Some of their customers go full bore and they implement insurance companies. Kayleen, is it okay I take a couple of questions, I think, because I think they're good conversation points.
Yeah, let's go.
Perfect. And Roberto, before you start, I want to add one other quick point, especially for the syndicators that are on the call, is what a strategic this can be to figure out if a deal is going to pencil out, right? Because now you can actually get solid numbers and hard numbers on what this would look like. So if you're a syndicator and you're syndicating, how many thousands of units a year, and you're able to have a actual program where this is what the cost can be. So it's something to think about, and because it can really help, again, determine if a deal is going to pencil or not from that one component on the risk side. Roberto?
Yep. So there's a couple questions here, right? There's one from Roger saying, what happens in a catastrophic loss, right? Who comes up the cash and when? There's two ways to think about that. One is a single catastrophic loss, right? $100 million loss. You had a hurricane and you had a terrible situation. You're always going to buy excess insurance, either through the reinsurance market or the retail market. So your, let's call it art program, will only be a portion of it, a very, very finite portion. So a common structure would be on a property placement that you fund for the primary $5 million layer over 3 years, and that's your worst case scenario in a single occurrence, right? So that kind of puts you in perspective. The follow-up question is, well, what happens if my program is underfunded in years 1 or 2 because I've created a funding mechanism that requires 3 years of funding to be fully funded? The reinsurers, in effect, step in and make a bridge loan, right? They basically pay the claim, which will be paid back with additional premiums in years 2 and 3, and that is understood. And that goes back to let's call it the stability the program provides, right? You understand what your max downside is and what the additional premiums might be and how it all works over a multiple year basis. The second question, I think, is really interesting, right? Which is basically marrying the approach of financing and structuring capital effectively with proactive risk management. And I think TC has an incredible, this is actually experience, right? On proactive risk management, which is the heart of this, right? If you're actually really good at managing your risk, this is where it's good. So TC, I'll kick it over to you.
Um, I mean, I'm not sure I'd say this is my hill to die on, but maybe it is. But we've gotten into this cadence now where, we'll present results to a client, and Roberto will always ask me, TC, what's the number one cause of property loss within this portfolio? And I'll say damage from water leaks, right? And it always is. I mean, damage from water leaks is an incredibly prevalent cause of property loss. What's the market penetration for leak detection in commercial real estate? It's less than 5%. So the question comes, why, right? Like when something about the communications dynamic here is broken. And it goes back to a previous point. If you're buying insurance on an annual basis, and in many cases, the person you're buying insurance from next year is not the same person that you're buying from this year, it makes it really hard to financially incentivize proactive risk mitigation. And in addition to that, when you do not have access to your own underwriting surplus, your proactive risk mitigation is mostly going to support somebody else's balance sheet and profitability, right? What I think is so potentially impactful here is when you control those things, all of a sudden the corpus of money that you have to play with is significantly greater, and the financial incentive for proactive risk mitigation is significantly greater. And the reality is, we don't see it a lot from the commercial real estate perspective, but insurance companies are running risk engineering reports on properties all the time, and those reports tell you in granular detail, what certain actions taken or not taken at a property and how that will impact, the perception of risk or the actuarial science behind risk. It's incredibly valuable information, and we plan on making that information available to all of our clients. I think, within real estate, it's really hard to make a capital allocation decision or any decision when you can't determine the return on investment, right? Even if in your heart of hearts, this is probably going to yield benefit. Without the numbers, it's almost impossible to move forward. And we're going to give people those numbers in granular detail. We're going to say, hey, if you put leak detection throughout this property, we think it'll reduce expenses related to water damage by, X amount. And if you just put the cost in the numerator and the savings in the denominator, there's your ROI. And so we think, the goal here is to give people the full menu of options that they can, look at and determine where it's best for them to put their capital.
I'll end up that comment with, we were reviewing a portfolio earlier this week. 70% of their losses are water leaks and 20% are slip and falls. So the point is, where should we be focusing our risk mitigation dollars? Leak detection and fall protection, right? The next question from Andrew, minimum size. I'll answer that. It depends, right? To use Jordan's answer, it's truly about two things, geographic or jurisdictional exposure. For example, if you are in a Midwestern state with a portfolio that's heavy in Ohio and Indiana, probably you need to have a much larger portfolio for this to pencil out because they're not exposed to tough jurisdictions or geographic exposure, right? So in that case, a bigger portfolio, let's say $1 billion plus, starts penciling out. The second is, well, if you are exposed to geographic or jurisdictional exposures, things New York, Florida, Texas, California, then a much smaller portfolio starts penciling out. So I'll answer that with saying that this starts making interesting an interesting proposition when you're spending about $3 million in premium per year, right? Because you're looking to save that 20% of premium, which would be $600,000, and that starts grabbing people's attention. Roger went back with another question. Yeah, the fronting question. So yes, from a market perspective, the fronting insurers are your name brand insurers, right? They're A plus or A minus rated, depending on what your needs are, size, or it would be name brands, AIG, Star, Nationwide, the common nationals, which you would be renting their papers from. And from the market's perspective, you wouldn't know that there is a non-traditional transaction on the back end, right? It's the same question, for example, as who reinsures Travelers, right? Travelers buys reinsurance from a number of reinsurers, but that question never gets answered because the fronting carrier, Travelers, in that case, is taking on the credit risk. So there is that, let's call it credit worthiness that the market is expecting with general terms and conditions that are market driven that would be expected from these transactions. So it's a very standard transaction on the front end. What's really changing is the mechanics in the back end, the funding mechanism. And I think we have one more slide. John, I think these are our closing remarks. I think it's interesting, right? This is a common, there are two comments here in the current state of the market. The reinsurance market is the marketplace, and most clients on the retail side are accessing the reinsurance marketplace through retail channels, right? So when we think about soft and hard market cycles, they all emanate from the reinsurance market, right? So when the reinsurance market is in a hard cycle, the retail market goes along, and vice versa. So when you start thinking about your own strategies, you should consider addressing the whole market, not only the retail side of the market, but also the reinsurance side of the market. That's a long way of saying that if there's a good transaction to be had on the retail marketplace, there's probably a little better transaction to be had directly with the reinsurance market, right? I don't know, TC, or John, you want to double down on that?
No, I mean, I think you captured the market dynamics well. I mean, in terms of like where is the current market going, I think when people talk about, softening market, that's primarily related to property. But at the end of the day, property insurance is really driven by construction costs, right? It's driven by increasing replacement values and the fact that when there is a damage event, the cost to replace that structure is just significantly greater than it previously was. So, I mean, the question comes, what do we think is happening in the construction market? Do we think that those costs are coming down? I haven't seen it. Something significant would have to happen in the construction market just to see even cost stability. But at the end of the day, that is the main driver of pricing, whether it's retail or it's Roberto's point, reinsurance. And then the general liability market, I mean, we have access to market data and we see the filings that are going on a state by state basis. And that market is not soft. We would expect that market to be more expensive next year than it is this year, pretty much across the board.
We talked a little bit about strategic approach to claim already. It kind of stole our thunder on the question. So, but it is about focusing on the data that we have, what's driving our losses, and then managing them to our benefit, right? Um, and then the last point, achieving stability and savings versus the traditional market. I think that I can't emphasize this enough, which is it is absolutely unnecessary to buy insurance on a single year, single line basis. What do I mean by that? You have an operation, right? You're a real estate owner that has been in operations for a number of years, and you're going to continue being in operation for a number of years. And it is not to your benefit to not think about your risk financing, your insurance purchase on a single year, single line basis. Single line meaning you buy general liability from one side and property from the other, and so forth. The idea is that when you want stability on your pricing and understanding of how it's going to develop year over year, you have to look at this over a multiple year basis, over multiple lines, and have a roadmap of how what you're going to do when the market conditions change. For example, if the market hardens because of a natural catastrophe or a number of liability claims that you might have had, what am I going to do then, right? It's not going to go to the marketplace and go get quotes. It's actually reacting effectively to your own particular set of of exposures. And the same thing on the other hot side. If the market becomes really soft, right? All this capital comes into the market and rates go down and construction costs go down. Well, how am I going to react? I'm going to buy more retail insurance. I'm going to offload risk from my balance sheet, or am I going to continue in my art structure? And the answer is that you're in every day, periodically, you're reassessing that position, right? Let's call it anniversary cycle or renewal cycle. You're addressing how much you're actually funding for your losses and ultimately how much you're going to be transferring to the marketplace. And I think that's what we have. Well, it's pretty good on time, 48 minutes.
Yeah, I have one quick thought to add. We talked about the modeling, right? When you say, hey, what's my expected losses and forecasting and the actuarial component, which I'm sure many of you have seen this from the brokerage and so forth. That is very powerful information, but the one thing to keep in mind is the inefficiency of how you're getting to that capital. Those 7 boxes that Jordan asked, hey, can you guys answer what those are? If his children were taking the test or were those children taking the test? But if you think about that piece, this right here. So yes, us brokers, we do all this actual modeling. Hey, here's where you should be. But again, it's how are we going to get to that risk capital? What is the most efficient way to get there? And is it spending that 20 to 40% distribution cost to get to that? Is it worth it to do that way? Again, once you've gone through all of these, the modelings, you're going to be able to tell, hey, what is the most strategic thing? So I do want to stress it's not just about the data and the information and the actual modeling. It's now how do we get to the capital most effectively? So with that, Caitlin, I know you have some closing thoughts, remarks, and also I think some business pieces on the association side, and also those who are interested in really getting into a deeper dive with this, how you can connect with us.
Yeah, I think this was really great. One question for you, and this gets a little bit to what you were speaking about. What does the underwriting process look like for folks who might be interested in taking the next step?
Yeah, Roberto?
DC, you wanna jump in this one?
Yeah. So the underwriting process looks, very similar to a typical underwriting process. We just go into a lot more depth. So the three sort of data sources that are core to the analysis are similar as a traditional insurance process. So the statement of values, loss runs, ideally for 5 years for, whichever exposures, preferably both property and general liability. And then the existing master insurance schedule or the existing, insurance policies are in place, so we can sort of compare the existing policies with what can be achieved via alternative risk transfer strategy. That's today. Where we're going as a business is, what I profoundly felt, on the insurance buyer side of the table is the results are not good, but the process is also really painful. right? You spend a lot of time furnishing information into a black box. You don't hear back right away. The market will wait to quote you until like the day before you need to bind.
You don't have a choice about it.
Yeah, you don't have a choice about it. You have no options at that point. And what we're building from a technology perspective is we're building, tools that are highly efficient at data ingestion. So our goal is, is from a company's perspective, which we haven't really talked about, but our goal is to be able to basically ingest your data in an automated fashion and then show you that comparison as quickly as possible, right? To give you the full breadth of options that you have in the market and then to choose the one that you find the most valuable, right? And then going beyond that, there are, other data sets that we will be accessing and asking for, like repairs and maintenance, like work order ticketing, right? I think like there's a lot that we can do from the data science perspective to create that better marriage between the strategy around risk transfer and the strategy around operational risk management and mitigation.
Well, kudos to what you and the team have built. I'm excited to see where this goes and hope to hear a lot more success stories. I did want to just mention we have some upcoming events. I was laughing when TC was giving his answer about what does most of the claims come from, and it's water leaks. In 2 weeks, we're having a webinar on water leaks. So you couldn't have teed that up better for us if we tried, and this was not planned. But yeah, we're gonna have Ion is sponsoring that webinar about their water optimization platform. So join us in 2 weeks, same time, 2 p.m. Wednesday. And we're getting ready for our Fall Developers Forum. That's going to be in 3 weeks here up in Boston. And actually, on Tuesday of this week, we finally launched registration for our annual meeting down at the Breakers in Palm Beach. This one will sell out, so I encourage everyone to sign up quickly while the rooms are still available. But just wanted to thank our panelists and everyone for joining the webinar today. I think you guys are really innovating and bringing a lot of solutions to what has been a really difficult marketplace. So kudos to all of you, and thank you all for your time today.
Thank you.
Thanks for having
For
us.
having us.
Bye-bye.
Have a good one.